Welcome to this channel, Accounting Basics. Don't forget to subscribe, share, like and comment. In today's video we're going to be talking about statement of cash flow, IAS7, International Accounting Standard 7. When you hear about cash flow, what comes into your minds? That's automatically money coming in and money getting out of the business. Cash in and cash out. The statement of cash flow summarizes a company's cash flows for a period of time. We deal with cash flows to show the effect of a company's commercial transaction on its cash balance. Basically, with cash flow, we deal with cash and cash equivalents. We deal with that cash balance, the money you have as cash. How is it flowing out of the business and how is it flowing into the business? Cash flows are used in investment appraisal methods such as net present value, and hence a cash flow statement gives potential investors the chance to evaluate a business. So potential investors look at cash flows to see how your business brings in money and how your business gets out money. This helps them to know if your business is operating well or not. So let me hope you have a question, because I will be discussing this, hoping you have a question in your hands. This will help you to follow up very well. We'll be giving you the format, how we do cash flows, how to handle each and everything in cash flows. Looking at your question, let me hope you have. Let me first talk about activities in cash flow. In the statement of cash flow, we have activities, and they are free activities. We have operating activities, investment activities, and financing activities. So cash flows are summarized through these activities. Operating activities sometimes brings in cash and sometimes takes out cash. So investment sometimes brings in cash and sometimes takes out cash. So we are going to look at how it brings in cash and how it takes out cash. So we are going to also look at financing activities, how they bring in cash and how they take out cash. Look at your question. You're seeing the statement of profit and loss for the period ended. That is the statement of profit and loss. That is sometimes you can call it the income statement. You have it in your question. And you have a statement of financial position, that is the balance sheet. In this balance sheet there are 2 years. As you can notice, we have the current year and the last year. So we are going to be connecting them and see how much we had in this year, in the current, how much we had in the last year, and how much we have in the current year. So there we will be in position to know if we had a cash inflow or we had a cash outflow. So dealing with the format of a cash flow. We are going to first deal with the cash flows from operating activities. Hope you've wrote that down. We are going to first deal with cash flows from operating activities. In cash flows from operating activities, we first note the net profits from operation. Net profits from operation, what do we mean? We mean those profits you have before interest and before tax. You've not deducted interest, you've not deducted tax. So those are the profits we get from operation. So if they are profits, we add those are the profits we have, so we add them in the cash flow. So we had depreciation. Why are we adding depreciation? Depreciation is not a cash inflow. Depreciation is not a cash outflow. So dealing with when we're looking at cash outflows, we normally focus on things that deal with cash. Bring in cash, takes out cash. So depreciation is the loss in value. So if a car was at a cost of 1 million and you find out that it is now valued at 800,000, that does not mean that cash went out of your business. No, you can't consider that as a cash outflow. So we're adding depreciation back because we subtracted depreciation in our profit and loss account. We subtracted it as an expense. So we are adding it back to remove it from our net profits. Hope you've got me well. Add it back because it was removed. So the net profits we have don't have depreciation. Yet depreciation is not a cash outflow. So we add it back. We are still under cash flows from operating activities. First of all, we added net profits from operation. Now we are adding depreciation. So when we add depreciation, we go on to profits. So when you realize that you had a profit, you less that profit. Why are we lessing profits? Because it is in our net profits, so we're lessing it. Most of you may be seeing profit as a cash inflow. No, but we are lessing it because it is our net profit. It is in the net profits, so no need to add it back. That will be a repetition. So if we have a loss, then you add a loss. You add a loss to cater for this net profit. So working capital helps us in the day-to-day activities of the business. So we see inventories. How do we deal with inventories? When inventories are increasing, as you can look on your question, you have the current year and the last year. So if you see that inventory is increasing, for example, in the last year it was 5,000 and now you're seeing it is 6,000 in the current year, meaning inventory is increasing, but you bought that inventory, meaning money was flowing out of the business for you to purchase that inventory. So you will have to less it in the cash flow. So if inventory is decreasing, for example, in the last year it was 5,000, but now it is 4,000 in the current year. That means money is flowing in because you're selling that inventory. So you have to add it because it's a cash inflow. So what I forgot to tell you is that cash inflows, we add them, and cash outflows, we less them. So when you look at trade receivables, we are still on the working capital. Trade receivables, when money, for example, trade receivables, when they are increasing, we less. Trade receivables, when they are increasing, we less. Quote me well. Trade receivables, when they are increasing, we less. Why are we lessing? Because these trade receivables, they are like people with demanding are increasing. It doesn't mean that money is coming in, but people with demanding are increasing. So when they are reducing, trade receivables are reducing, there we will have to add, because money is coming in, we're receiving that money from our debtors. When we looking at trade payables, when they are increasing, we add. Trade payables, when they are increasing, we add. So trade payables, that is the money we have to pay. When it is increasing, we add, because we are receiving it, that's why it is increasing. But when it is reducing, we less, because we are giving out that money to those people who gave us their goods on credit. Hope you're getting me well. So there we are still looking at cash flows from operating activities. And then how to deal with taxes. Taxes, when you pay taxes, that is a cash outflow, so you're going to less it look at your question very well. If it said that you paid tax, so you have to less. If they paid you, you have to add. If you're the one paying interest, you less. If they are paying you interest, you add. Dividends paid, you less it, because you're giving money out to your shareholders. So there we get the net cash flow from operating. After adding all that, we get net cash flow from operating activities. So looking at cash flows from investment activities, you invested in money, but you want to know how did the money flow in and out during the investment activity. Purchase of non-current asset, you're giving out money, you're buying a car, you're giving out money. That is a cash outflow, so you have to less it. So sale of a non-current asset, you're selling your vehicle, you're receiving money, you will have to add it. That investment income received, for example, you're receiving something like a profit from a business you invested out of your business, so that you will be receiving money, you will add it. Net cash flows from investing activities, you add all what brings in. So in cash flows from investment activities, you look at the things you invested in money. How did they bring in money and how did they take money? But if they say bought that car, but you had to take that car for repair, taking that car for repair means you took out money. That's a cash outflow. So looking at financial activities, financial, when we talk about financial, something to do with finance, that is issue. We are going to look at issue of shares. You issue shares, meaning people will have to apply for those shares, subscribe for those shares, they will have to pay. So you're receiving in money. Option shares, you have to less them because they take out money. Loans or debentures and bonds. So loan, when you get a loan from the bank, you're receiving money. That's a cash inflow. You're bringing in money. So in cash flows, we don't look at whether you're getting money. Are you going to pay that money back? Are you not going to pay that money back? What we're looking at is that cash flowing in, is that cash flowing out. That's what we have to look at mostly during with cash flows. So redemption of loans, you're paying out loans, meaning you're giving out money. That's a cash outflow. So
yeah, thank you for keeping in touch. That's what I can do for now with cash flows. Wait for the next video. We'll be explaining more about cash flows, how to deal with them, how to attempt questions, how to prove your answer is right. Thank you so much. Don't forget to subscribe, to share, like and comment. Accounting Basics. God bless you.